Now let's bring in our market panel. Keith Lerner of Truist, Bob Dahl of Crossmark Global Investments. Keith, you are saying that you can't keep your portfolio strategy on autopilot heading into 2024. So, I mean, today, though, might have been a day that autopilot might have been okay. What's going to change that?
Yeah, great to be with you, John. You know, the market overall has done really well the last few months. And, you know, off the October low on that pullback, we thought that was an opportunity. We're still in this seasonal positive period, and there's just not a lot of selling pressure. So I think we can continue to squeeze higher into year end. As we move into the election year next year, what tends to happen is the first half actually tends to be a bit choppier. And as going back to why it's not a time to be on autopilot, I do think there will be tactical opportunities. When we look at all the different cross currents that we have, one, again, the election year tends to be somewhat bumpier. And then also, when the Fed cuts rates for the first time, when you look 12 months forward, the market is really dependent on whether we do achieve that soft landing or we move into a recession as far as whether you're up, double digits to the upside or downside. So I think there will be a lot of things next year that's going to cause more volatility that, like I said, it's being suppressed now, that will provide opportunities to go on offense or defense. But I think right now we enjoy the ride into the year end and then expect somewhat of a bumpier path in the first half.
Bob, you point out that we're in a different economic and inflation environment than we've been in for the past decade. How should that shape the way we think about 24?
Look, I think it's seasonally strong now, so I'm in agreement there. But I look at my screen, I see stocks are approaching 20 times forward and over 20 times trailing earnings. We've had a great year in the last month and a half. Stocks up 13%. Like late October was a time to add. I'm not convinced that one shouldn't think about into year end taking some profits and anticipating some lower prices. Look, the expectation, as we all know, is inflation's going to continue to fall, the Fed's going to cut rates, and earnings going to be up a double-digit percentage. That's a lot of good stuff that happens simultaneously. If we can make it happen, that's a big if in my view.
Okay. Keith, I mean, you talk about how important it is looking to 2024 to not be on autopilot. What does that actually entail? How does an investor position themselves going into next year? And what are the key signs or factors or data to watch in case you do need to be nimble and make changes?
Sure. So right now, because the calendar changed, our strategy hasn't changed. We're overweight the U.S. on a global basis. We're still overweight large caps relative to small caps, and we're overweight high yield. So some things we've been looking for is, if we have deeper pullbacks, I know we've had this little bit of a run in small caps. I don't know if that's a sustainable change. At some point next year, if the earning trends start to hook up, I think investors should be prepared that, this cycle could be different, that small caps actually work better when the economy is somewhat slower. And normally small caps are first out of the gate, so maybe they start doing better later in the year. At some point next year, we are really underweight international. We have zero exposure to emerging markets. Again, at some point next year, they may come to a point where the price is right and we start to see an earnings inflection that we'd want to shift. So again, our message is stick with our current strategy. It's working. But at some point next year, we think there's going to be several inflections. We're not going to try to press our narrative on the market, but be ready for kind of these inflection points in all these different markets, including going back to the bond market where we're focused on high quality. At some point, we think spreads will likely widen, which will provide an opportunity as well. So again, we're being patient in that respect, but also realistic that we are going to be in a choppier environment.
Bob, I mean, market's not expecting the Fed to make any moves one way or the other tomorrow. It's a pretty high bar to expect, probably shouldn't expect, the Fed and Powell to even be talking about the possibility of rate cuts, though we will be getting the dot plots and the forecasts for next year as well. It's not a matter of if, but probably a matter of when and why the Fed starts cutting. How important is the why piece of this looking to next year and what that's going to mean directionally for stocks?
Hugely important. After the last Fed hike, let's assume we've gotten that, stocks tend to do okay. They begin to struggle when the Fed starts cutting rates because they're doing that because the economy is weakening and earnings are suspect. That's what I'm worried about when we get to that point. I think there'll be some more weakness, and therefore you need to be focused on companies with high earnings predictability, high earnings persistence, knowing we're going to have some disappointments down the line.
Keith, finally, you want to go to sectors. You're underweight consumer staples, healthcare, materials. Healthcare has had a really rough go of it this year, and you say that you're prepared to shift things. So what is it perhaps even in 2024, that would cause you to get more bullish on a sector like healthcare that, demographically should be doing better, but has been struggling?
Yeah. Well, the first thing, we're staying overweight technology and communication services. The earnings momentum remains there. If we look at things like healthcare, utilities, materials, the relative trends are still weak, and the earning trends are weak. So I think to get more positive on things like staples or healthcare, what you're likely going to see is that the economy does weaken. So you'll be looking at things like credit, and you'll be looking at things like initial jobless claims as well. Healthcare is an interesting sector. It always looks cheap. We call it the Charlie Brown of sectors. Every time it looks like it's starting to get going, it loses the football again. So we want to see the earning trends move up. We want to see relative price turns up as well. And that means we're just going to be patient. We're not trying to call the top of the bottom, but we want to be in the meat of the move. And right now, healthcare isn't showing any signs of turning around at this juncture.